Since the dawn of history, there's only been three places to store wealth. No matter how you slice it up, you can either put your money in a property, which is real estate, stocks, farmland, or you can lend your money out. You can lend your money to your brother-in-law, you can lend your money to your bank, you can lend your money to General Electric Corporation in the form of a bond, or of course you can lend your money to the U.S. government. The safest place to lend money, of course, is the U.S. government because they can print it. The third place you can put your wealth is the opposite of money. Sugar, orange juice, gasoline, oil. These are commodities. So no matter how you slice things up, there's only three places to store wealth. The mystery, since the dawn of time, people have been struggling with where to put your wealth. I always look at this not where the best returns are going to be, but maybe we look at where the risk comes from. There's a story back in southeast Missouri during the Civil War when the Yankee army was coming through. They were raiding these Confederate farms, the Confederate sympathizers, and they were stealing their gold. So the Confederate sympathizers, these farmers, decided to bury their gold under fence posts. Now, would you think they buried their gold under one fence post or more than one? Of course they would bury their gold under more than one fence post. So when it comes to your wealth, think about these three spots, equities, bonds, and commodities, as three different places to bury your gold, to store your wealth. All of them have risk to it. You can't avoid risk. But since World War II, when the economy is expanding, the equities, the property market has produced the best returns. Back in 2008, during the financial crisis, the only place that provided a return was a U.S. government bond market, because that was the only place that had certainty. Now, of course, now recently, since 2008, the Federal Reserve has this crazy quantitative easing policy that prints between $80 and $100 billion of new money a month. Now, at some point, is that going to have a consequence? Is the purchasing power of your dollar going to be the worst risk? Could it be devastated? What happens if eggs are $100 a dozen? If bologna is $90 a pound? You certainly don't want to store your wealth in bonds if that happens. So commodities have some appeal. The most prudent strategy is to spread your money around, to diversify under these different equities, bonds, and commodities. That is the best way to manage wealth, is to focus on the risk and not to chase outcomes. Several academic studies have concluded that the allocation policy, your investment allocation policy, is responsible for at least 94% of the investment performance. That means your decision, your executive decision of how much of your wealth to put between equities, bonds, and commodities is far more important than who you choose as a money manager, what mutual fund or stock you choose. It's the allocation that drives performance, not the money manager, not the mutual fund manager, not the name of the investment firm. It's the allocation. The timeless mystery is how much of your wealth to bury under these different types of assets.